In this segment, we're going to talk about how you get paid. You obviously create a lot of value and do a lot of work for a lot of clients and prospects. And obviously, you're in business to monetize those skills. You give the value of advice and guidance and coaching, and it's important that you get paid fairly for the value that you're creating. You solve problems for clients and prospects. You take them from where they are now, you learn where they want to be, and you put plans together to get them there, and you execute those plans. You help with college savings planning, retirement planning, cash flow planning, risk planning, budget, insurance, all those things. You take all that expertise and you deliver it to the clients to solve their problems. So let's talk about that a little bit. Let's talk about how we get paid. I'm not going to break it down like I would in front of a client. I don't share this stuff with clients. There are ways that you sell fees to clients and commissions, but this is just me explaining to you how the fees work, how you get paid. We're going to use a 35% payout, meaning that you get paid 35% of the revenue that you generate. You're going to hear terminology in this business in terms of a GDC, gross dealer concession. That basically means gross, how much goes to the broker-dealer, to Money Concepts. You get your cut of the gross dealer concession, GDC. You'll hear people say, what was your GDC last year? What was your GDC last month? That's referring to your gross commissions that go to the dealer, Money Concepts. Once it hits the dealer, you get your cut of that. In this case, 35% of GDC. We get paid several ways. We can get commissions, I'm just going to abbreviate, commissions, trails, advisory fees, and let's call the last one fees for service. A commission would be like you sell a product and you get a commission. For example, if you sold a variable annuity, we use the commission schedule that oftentimes gets the GDC on that product to be 4%. By selecting that particular commission option, it also comes with a 1% trail, oftentimes. To show you how that works is, let's say that you invested $100,000 into a variable annuity that pays a 4% commission and a 1% trail. 4% is, of course, $4,000 of commission. 35% of that equals $1,400 of income to you as the advisor. The 1% trail is what's paid annually to the advisor for keeping the account on the books, for servicing the client. 1% of a $100,000 account value is, of course, $1,000 of GDC trail per year, which of course equals $350 per year ongoing. Now ultimately the 1% is based on the account value. So if the 100,000 turned into 110,000, then the 1% is based off the 110 that year. If the 110 or the 100 falls to 90, then the 1% is based off the 90. So the 1% is based on the account value. The 4% is based off of what goes into the account. The trail is either paid monthly or quarterly, depending on the company that you're using. So if it was paid quarterly, you'd get roughly you'd get your share, you get GDC of $250 per quarter. Paid monthly, you'd get about $83 per quarter, paid per month, sorry. So this is ongoing revenue this is upfront. There are annuity options that give you, for example, an 8% upfront commission. We don't use those here because then when you do 8%, there's no trail. There's no ongoing reoccurring revenue. So we always choose the commission option that pays about a 1% trail. Some will pay 0.75, some might pay 1 1/4, but we're going to zero in on that 1% trail, and most of those 1% trail products will pay about 4% up front. So that's how commissions work with a variable annuity. If you're using a mutual fund, depending on if you're doing A, B, or C shares, may pay anywhere from a 1% upfront GDC to a 5% upfront GDC. The trail, again, would depend on what share class you use. We're not going to go into A, B, and C shares right now, but just know that most commissionable products are going to pay you something up front, and if you structure it correctly, will also pay you some sort of trail as well, which is ongoing. Moving over to the other side of the board, this is advisory services. Again, this is more transactional, commission-based services. When I refer to advisory fees, I'm talking about getting paid to manage money, an advisory account. I'm not talking about getting paid by the hour or getting paid to put a plan together. I'm talking about getting paid to manage money. In our advisory accounts, we have the ability to charge a 2.5% initial advisory fee. This is initial. And up to 2% per year ongoing. So this is the annual advisory fee, and that's the 2.5% initial fee. Ongoing fees are paid quarterly, so if you divide it by 4, that's 0.5% per quarter. The example I'll share with you here is if you had $100,000 with a 2.5% initial advisory fee, that's of course $2,500 of GDC. $2,500 times 35%, you'd have to do the math on that. In fact, I've got a calculator. Would generate $875 of income to you as the advisor. 35% of the GDC. Now, when it comes to figuring out your income from the advisory fees, there's an extra step you need to take. Whatever you're going to charge ongoing, and by the way, both the initial fee and the ongoing fee are negotiable. You can reduce them to as low as you want to. You reduce them too low, you're not going to get paid very much. But you can charge anything lower than those numbers. You can charge 2%, 1%, 0% up front. You can charge 1% a year. Doesn't matter. Whatever you charge for the initial advisory fee, the entire amount hits your GDC that you get 35% of. However, with the ongoing fees, there's one extra step to the calculation that you're going to need to do. Whatever you charge annually, you need to subtract 0.5% from that number in order to arrive at your GDC amount. So for example, if you charge 2% per year minus 0.5%, 0.5%, that equals 1.5% per year of GDC. That 1.5% is, quote, what hits your grid that you apply the 35% to. This 0.5% is what goes to Pershing and Money Concepts to provide the advisory services. The 1.5% on a $100,000 investment, of course, generates $1,500 of GDC per year, of which you get 35%. 1,500 times 35% is $525 of annual income to you by keeping that $100,000 plus or minus account on the books. Again, ultimately, this advisory fee, the exact amount you get, depends on exactly what the account is worth at that moment in time when that quarterly fee is struck. But it's important to note that when you do the math on what that account is worth to you from a residual income standpoint, to always take the 0.5% off the top of whatever you're charging to arrive at the GDC so you can figure out what your income is. I'm going to circle back to residual income here in a moment. The last thing I want to talk about is fees for service. Fees for service is pretty cut and dry. You can use what's called an E360 agreement or an engagement letter. E360 or engagement letter. These are both legal documents that Money Concepts provides to us that allows us to charge a flat fee or an hourly rate for service. The E360 you can bill one time. Let's say you charge someone $1,500 or $2,500 to put a financial plan together. That can be a one-time fee. The client signs it. They give you a credit card number. They write you a check. You can debit it from a brokerage account, and they pay that fee. Let's say you charged them $2,500 initial advisory fee. Scratch that. Not initial advisory fee, a planning fee. $2,500 fee. That entire amount hits your grid, you get 35% of that fee. So everything you generate in terms of commissions, trails, fees for service, initial advisory fee, all those things you get a 35% cut of. The only nuance when you're figuring out your GDC is to remember to subtract the 0.5% from the annual fee that you're charging in the advisory accounts. We have some really good spreadsheets that our team can share with you that shows just how powerful the residual income is, just how powerful the trails and advisory fees are to you. But I'm going to break it down really simple just to give you an example. Let's say that the average trail on your annuities is 1%, and let's assume that the average GDC that you're going to charge a client for the advisory services is 1.5%. Well, if you have a $20 million book of business, the average between these two, let's assume that it's 50% advisory and 50% trails from annuities, for example. The average, of course, is 1.25%. So 1.25% is $250,000 of annual GDC just from trails and advisory fees, not having to sell any commission products. You get 35% of that, which is $87,500 per year, just to show up and service those clients. You don't have to sell anything, and you have that much money coming in per year just by servicing that $20 million book. What if you managed $40 million? Well, all you do is divide that by 2. If you managed $40 million, your base income, fees and trails, $175,000. What if you managed $80 million? Well, if you managed $80 million, then your residual income is $350,000 a year just in trails and fees, residuals. Now, you're obviously not just sitting on your hands collecting this money. You're also out there prospecting, bringing new clients in. So imagine here you are at the $20 million level, making $87,500 per year in fees and trails, and let's say that you're bringing in $5 million, which is hopefully on the low end of things. You're bringing in $5 million and getting an average upfront of 2% per year on that money. Of course, we can do the math in our heads, but I'm going to do it here for kicks. That equals $100,000 of GDC that you're going to get 35% of, which is $35,000 of commission income on top of your trail income, which equals a pretty nice sum of money. That's a very nice income for anybody, and that's only managing $20 million and bringing in $5 million of new money. Now, it takes time to build this, it takes time to do this, but once you're here for 2, 4, 6, 10 years, what have you, you can certainly build up a $100, $200, $300 million book of business as your career progresses, collect some fantastic residual income, and bring in 5, 10, 20, 30 million a year of new assets, and you can see how you can really make some serious money in this business. Fast forward to a $100 million book of business with a 1.25% trail. That's, of course, $1.25 million of GDC. Get 35% of that. That's $437,500 of base residual income. Now, you might be asking yourself, well, where does the rest of that money go? Well, it's simple. Money Concepts, our broker-dealer, gets a piece of that money, of course. Pershing, our clearing platform, gets a little piece of that money. But a large portion of that, of course, comes to the Trinell Financial Group, the company. The Trinell Financial Group is taking the risk of you being in business. They absorb your liability insurance costs, all your overhead costs. There's no rent that you pay. You don't have to pay for staff and employee benefits, computers, phone bills, you name it. Think of everything that goes into running this practice. Your marketing materials, the cost of the mailings to send out for your seminars, all the insurance costs I mentioned, all the overhead, the staffing, you name it. The attorneys that we have to hire to do the right things in our business, the CPAs, etc. All the salary for all of the staff. All that money goes into overhead. Your income right here, in this example, this $437,000 or this $35,000, this $87,000, whatever, that's your money, free and clear, no risk. You did not have to make any investments into the business financially. You're not taking on any liability risk. Now, obviously, if you're doing something fraudulent and wrong and you get sued, that's your problem. You'll be taking on the full brunt of that expense. But you're doing things by the book, doing things right, following our policies. If bad things happen, you get sued by some client who just wants to sue you, well, that's what the E&O insurance is for, and that's where the company comes in. There's a ton of overhead in this business. You get to net this free and clear of everything. The company has to use the other money to run the business and make a profit even after that. Money Concepts, as I mentioned, gets a piece of that money too. So it can be a very, very powerful and lucrative business for you as an advisor. You're making good money, you're helping your clients out, the company's making some money, covering all your overhead, taking on all your risk, etc. It's a fantastic setup, and you are absolutely set up for success working here at the Trinell Financial Group. I'm sure you have more questions for us. Flag me down, flag any of the advisors down. They can certainly help you answer any questions you have relating to commissions, trails, GDC, how the payout works, etc.